Thanks so much for tuning into this earnings conversation with Mphasis, and as is the norm, Nitin, Rakesh joins in to talk about, and this time even Manish Dugar joins in from US to talk about how the quarter was and how the quarters ahead could be like. Gentlemen, thanks so much for joining in. Nitin, 4.1% QOQ net revenue growth on a reported basis is okay. Constant currency 1.6, a bit subpar, you would think, or was this in line with estimates? And what went behind this?
Yeah, I think one correction. USD is 1.6, constant currency is 2, constant currency direct is 2.5.
Okay.
Because of the cross-currency numbers, the USD and CC numbers are different this time because currencies moved quite a bit in the last quarter. With that said, I think the growth was, I would say, given what we saw going on in the business this time last year and the elevated growth in the mortgage unit, I think this is pretty much as we expected to play out at the start of the quarter. The good news is that if you kind of peel away the nuances from the headline numbers and you start looking at where the growth is coming from, the quality of growth is actually very strong because we've seen 40% growth in the application outsourcing business. And a lot of that is led by offshore-centric growth. We've seen very strong growth in our home market of the US, which is 30%. Of course, Europe is a little bit headwinded. We'll talk about that in a bit. And we've also seen very broad-based growth across all verticals on a YOY and a sequential basis, barring maybe a blip here or there. And more importantly, the growth is also broad-based, as we always talk about client segments. Top 10, top 5, next 10, all have grown north of 20%. In fact, top 5, 30, next 5, 38, next 10, 24. We added one more customer to the 150 million plus LTM category. We now have 3 customers in 150 million plus, up from 2 last quarter. Average revenue from top 5 clients is 150 million. For a company our size, having 6 customers, over 50 million, all over 75 million is actually a very, very strong metric because that shows the strength of ability to actually go deeper with customers. New client business grown 60% on a YOY basis. Very, very strong performance coming out of our new client acquisition. We signed 11 new customers. Of course, we've got an asterisk on that within the MD&A because we wait for a certain revenue threshold to be crossed before we announce them. But 11 new signings is probably the highest we've seen in a long, long time. So I think many cylinders firing. Of course, there are certain headwinded segments. We talked about US mortgage, some softness in Europe given the geopolitics and the macro headwinds. Mostly not so much in deal flow, more in terms of ramp-up times and the ability to convert the deal flow into revenue. The best news, of course, though, is we are still in an environment, at least in our segments, both vertical geography and service line, where we have tailwinds on demand and we are headwind constrained. So we have a lot of execution focus right now to convert that demand into revenue.
Yeah. So the direct revenue growth 30% plus all of the 4 quarters FY22 Q1 you've done that, so that's great news. Even I thought on verticals except for insurance, unless I'm wrong, most did well. So on that count, there is no issue. Nitin, the question that I have is on deal wins, right? The new TCV in direct is very strong, but most people are talking about maybe a recessionary phase or close to that in the US. Europe is anyways involved in this. Do you sense that things could slow down, or do you have visibility for the year at large, or is it unpredictable after the second quarter?
302 million of net new TCV. We actually announced another $60 million deal that we signed in July with a top customer in cloud transformation, fairly accelerated, deal cycle and even more accelerated consumption pattern. At this point in time, in the segments we are operating in, which is the large banks, financial services companies, insurance companies, healthcare, we are not seeing major, at least in the current pipeline, major significant stress on demand. There are some customers, I would say a handful, where they had a big COVID boost and they're now starting to see a little bit of softening. So there will be some trickle down on that. But I think the way to think about it is, what segments are you playing in? And I'll give you an example. If you're in cloud transformation, if you're in modernization play, if you're transforming clients from legacy to the new tech stack, if you're helping them build a whole new platform, I think that you can still see very strong growth, pretty much in the numbers we are showing. if you're in a segment where you had managed services contracts, what used to be staple from 10 years ago is actually discretionary today. So I think the tables have kind of turned. We are still in an early cycle of the new tech adoption. The tech consumption is still pivoting. We are probably in the second innings of a baseball game, as I normally say. There is a slowdown coming, but I think the reprioritization will actually favor transformation over run. And that's the opportunity. The ability to run down legacy faster, the ability to cut, switch off a data center, switch off an infrastructure, an environment, not run duplicate, backup sites. That's where the consolidation will come, and that's not where we are playing. That actually plays into our hand. So I think it's a little bit, you have to go a little bit nuanced in understanding what is the portfolio, what is the service line, what is the segment of customer that you're playing in, and then kind of apply this macro mindset. For the longest time, we've not thought like this because almost every time there's been a straight line from recession to slowdown, because anything that was managed services and run was considered recession proof, anything that was dev and digital was considered discretionary. I think those tables have turned, this time around. So, and given that we are still in an early cycle of change the business or adopting new models and digitizing, I think people are going to use this. Many of our top clients are using this downturn or the expected downturn to actually continue to transform faster to pivot to new business models. So I think very, very different from the last at least two downturns that I've lived through, 2008, 9 and 2000, 2001. Of course, there was some cyclical downturn in 13, 14 that we recovered from. But I think there is more than what you can just draw a straight line from those playbooks.
Okay, I'll have a follow-up to that, but let me get in Manish in the conversation. Manish, what's your sense around, I know you guys don't give out telltale attrition numbers or otherwise, but I was looking at the two factors. One is the EBIT margins haven't contracted for a bunch of larger names they have. So what went behind that? Is it that there was an improvement in pricing or something else? Because Q1, largely everybody's spoken about some bit of price pressures continuing. So what's been the experience at your end?
Sure, Neeraj. I think we called it out when we did the guidance last quarter as well, that and we intentionally kept the lower end of the guidance 0.05 basis points higher than the previous quarter to indicate that there is reasonable degree of confidence on our ability to maintain and if not expand the margins. And that's what we delivered. It is, as you rightly mentioned, a combination of quite a few puts and takes, supply headwinds and the uncertainties leading to us building supply chain, which is what we did by significant increase in our fresher intake and hence taking a hit in the utilization, were all investments. And the tailwinds were price increase, tailwinds were operating leverage, tailwinds were what we are doing in terms of making sure that we are continuously upskilling and upgrading the talent. So while some of the supply constraints require us to give them increases, but they come with increased billing rates, so they are kind of self-fulfilling. There's a virtuous cycle. Sure. And obviously the mathematical benefit of reduced amortization of M&A charges and the stock compensation. So I guess that view of margin with a northward bias continues. And if you look at over the last 9 quarters, we have maintained that we will have a process by which we ensure long-term investments and short-term investments are done with an intent that we can dial up and dial down when there is a requirement. So I guess managing the profitability is not so much of an issue. We are trying to figure out how best we can carve out as much possible investments for growth. And I think we have been fairly successful till this point in time.
I think I'll only add one more point to that, Neeraj. I think the quality of growth also, apps offshore, probably the most profitable part of the business to grow.
Okay. Gentlemen, if you have 2 more minutes, I'll take a couple of questions. So one is to Manish and then the final one from Nitin. So Manish, one is of course on the employee cost side, but that notwithstanding, there is a belief coming back, or a belief in the investment circles at least, that now that the world is opening up, you are in US as well. So what about the other ancillary expenses? What do they do? And more importantly, while currencies are tailwind for now, if it becomes volatile, it becomes a CFO's nightmare. So tell us a bit about that.
Taking the second part first, we have taken a very conservative and very simplistic approach to treasury. We don't see that as a profit center. Our focus has been to ensure that treasury gives us visibility to a conversion that business can use to drive other decisions in the long term. So I think we are fairly secure on that count, at least in the near term, and we don't see volatility impacting the financials. You may have a reclass between operating profit and other income, but that's about it. So far as the
Other costs.
so far as other costs are concerned, it's not unexpected. The expenses are coming in, as you rightly mentioned. I am in the US, and so are many other of the colleagues, and travel expenses have increased from what they were some time before. We have more and more colleagues coming to office, which increases the infra expenses as well. However, none of that is something that we hadn't planned. In many cases, actually, we are working with the team to get them back to office. Some required by regulation, some the clients are asking for. So I don't think any of those costs are unexpected or are going to change our view of what we think the margin should look like, which is 15.25 at a minimum and a northward bias.
Got it. Nitin, one final question, because you're short of time. I had two questions rolled into one. One, would there be a possibility of a conversation on better pricing because of increased costs, or does the economic scenario negate that argument? And part two, something that I heard just from one company out of 6 that I've interviewed thus far, that there are some clients which might want to prepone the 2023 spends into 2022 because there is visibility now. There may not be visibility then because of the US scenario. Are you sensing that too?
So I think in a way they're kind of both related. At least for our portfolio, the pricing environment is still tailwinded. We are not seeing pricing pressure on the transformation programs, the digital projects, the data skills, the new platform builds, everything that's driving growth. We haven't seen pricing pressure. In fact, we are still funding a lot of the employee cost expansion through price increases of some form or another. So I think that we are very happy to be in that position. I would not want to be in a commodity portfolio or a legacy portfolio today, because that's where price destruction, volume destruction, accelerated ramp off, all of that's going on right now. And I think that this is the first year in the history of our industry where you will see a plus 30% growth company and you will see a minus 20% growth company, and they all belong to IT services globally. I've never seen the 50% delta in at least not in my career.
Wow.
On the second question around the whole issue of spends from 23 to 22, I can tell you that no CIO wants to leave 2022's money unspent. I think they're all focused on making sure that what's at hand gets consumed. There is obviously higher in-year spend available compared to previous years because of this whole CapEx to OpEx migration. I think it's still a little bit too early to talk about 23 trends, because we've only heard a couple of our clients starting to think about 23, and even there I didn't see, barring the reprioritization from run to change, I didn't really see anything that would worry me at this point. But I think we are so focused on taking what's in hand, consuming 2022. I think it's a little bit premature to talk about 23. We'll talk about it probably in October, November timeframe, if not January.
Okay, but no preponement conversations per se, right?
Not so. I wouldn't say preponement, but I think there is a sense of urgency to consume what's on hand right now.
Got it, gentlemen. All the best for the quarters ahead. Thank you so much for taking the time out and speaking to us today.
Thank you, Neeraj. Thanks as always. Pleasure to talk to you.
Thanks for tuning in.